Yeah, good morning, everyone. So, thank you everyone for joining in our today's live session on ESOP accounting and disclosures. So, we at Capita conduct frequently live sessions wherein we try to discuss on the technical topics related to ESOP. So, today we would like to have a discussion on the ESOP accounting and reporting. So, before we start, I would quickly like to give you an introduction. My name is Devashish Goyal. I am a chartered accountant by profession. Today, I have with me my colleague Soumya, who is going to take this session, and she is a chartered accountant by qualification. So she has helped a lot of Indian companies for implementing the equity compensation scheme. And so, welcome Soumya for the today's session.
Thanks, Devesh.
Yeah. So Soumya, whenever we talk about ESOP cost, so it plays a very vital role in formulating an ESOP policy, and it is one of the tricky area when it comes to implementing the stock option. So let's try to lay some groundwork for our audiences, and maybe then we can get into technicalities in detail as we move forward.
Okay.
So first, let's begin with if you could share some insights on what is an ESOP cost as a concept and what is its importance for the company.
Yeah, sure. Right, Devashish. ESOP cost can be a tricky area to start with to understand. So, as you know, for the most forms of compensation, like fixed pay or variable pays in the form of bonuses, the accounting is actually pretty straightforward because the ultimate payout which is made to the employees, it is the expense for the company. But in case of ESOPs, so ESOPs, they are a form of non-cash benefit. That is, the company is not paying directly to the employee, but the employee creates wealth out of selling the shares in the market. So that's how the accounting for ESOPs is different from these traditional modes of compensation like bonus and everything. Now, ESOP cost may seem just like a task for the finance team, but it is very important to compute it accurately, and this is for several reasons because it affects the profit and loss account of the company and the overall financial health ultimately. Also, it impacts the company's valuation and the reporting figures. And as we know, ESOP cost is spread over multiple years, which is the vesting period. So the decision on implementation of the plan has an ongoing profit and loss account impact over the vesting period. Hence, it becomes very important to manage and first of all to understand the entire life cycle of the ESOP and how each stage influences the financials of the company.
Okay, so it's quite interesting to know that ESOP cost is a non-cash item, and it is one of the important parameters when it comes to implementing a stock option. So let's take this forward, and with that foundation, if you could please help us understand, how exactly the life cycle of an ESOP works, and as in terms of when exactly the cost is incurred to the company.
Sure. Let's understand this visually through a life cycle based diagram. So, I request if someone can present the screen. Yeah, thank you so much. So, as you see, there are five stages to the life cycle of the ESOP. First is the plan approval stage, then the grant of options is made, and ultimately the options vest. These options are converted into the shares on stage 4 of the exercise stage. And once the employees have the shares, they can sell, and that's how the wealth creation for ESOPs happen. Talking particularly from the accounting point of view, this stage 2 and stage 3 for grant and vesting of options are very crucial. So the accounting cost, it is determined at a certain point of time, and that point of time is the grant of options. So the fair value or the intrinsic value, it is calculated based on the inputs on the grant date itself. So once cost is computed on the grant date, it is then amortized during the vesting period. So that amortization takes place from the grant date up to the vesting period. Let's just sum up this up with an example. So let's say a company, a hypothetical company, grants and will be granting an option on 1st of January 2025 with a vesting period of 3 years. So on the grant date, that is on 1st Jan 2025, the company will calculate the fair value of the options to determine the total accounting cost. That total accounting cost will be spread and amortized in the profit and loss account during the next 3 years, which are the vesting period. So ultimately, what I want to say is that the accounting cost impacts occurs between the grant date and the vesting date, the end of the vesting period. I hope this answers your question, Devashish.
Well, absolutely, it does answer my question. So there are basically two important milestones when it comes to the cost, ESOP cost. So as you mentioned, grant is where the cost is computed, and second is the vesting of options, wherein it gets amortized. This really helps us. Now let's take it forward now. So now we have understood when exactly the cost needs to be amortized. Now, if you could please help us understand how exactly this cost is calculated. And so just to stress upon, there are a couple of methodologies that I would like you to show some insights on. One is in the intrinsic value and second is on a fair value.
Yeah, right. So let's start one by one. Uh, so first, let's start with the fair value method. Now, first, let's understand when is this fair value method applicable. The applicability of fair value method is for the companies who are mandatorily required to follow the Indian accounting standard, Ind AS 102 or its counterpart IFRS 2. Now, what is actually this fair value? This fair value is the theoretical price prevailing at which the two parties are willing to exchange that particular option in the market. It is a theoretical price, which is calculated using the option valuation methodology like BSM and other models, which we'll discuss subsequently in this session. Now, another important question arises is that when is this fair value calculated? Is it actually calculated on the annually or on the each reporting period? So for equity based instrument, the accounting cost of the fair value is done on the measurement date. Let's take an example. This measurement date is the grant date. Let's take an example. Let's say a company in this financial year 24-25 decides to grant two times, first in November 24, then in March 2025. So, the inputs required to determine this fair value would be different. The share price or the fair market value could be different. The volatility in the share price would be different. Even the risk free rate could also be different. And hence, the two fair values would also be different. So, two FVs or fair values are required to be calculated in this case. And simply, how is the total cost calculated? It is the number of options which are expected to vest multiplied by the fair value of the options. Now, going to the intrinsic value method. So, the companies who are following the guidance note on share based payments given by the ICAI, they are following the intrinsic value method. Intrinsic value method is simply reducing the exercise price by the fair market value on the grant date. Now, another example we can take to understand this. Let's say on the grant date, the fair market value is rupees 70 and the exercise price is rupees 50. So 70, 50, that gives the intrinsic value of rupees 20. Another example, the fair market value remains 70 only, but the exercise price is also 70 now. So in this case, the intrinsic value is 0, which is the cost would be recognized in the profit and loss account. But if we would have done this by the fair value method, then some cost would have been recognized during the vesting period. There would be accounting cost because for fair value method, one component is the intrinsic value and the other component is the is the time value of the options. So this is one interesting difference that we observed between the Ind AS and the guidance note in the treatment of accounting cost. I hope this answers your question, Devashish.
Yes, absolutely. And generally, there is a confusion between the clients which
Yeah.
method that needs to be
Mhm.
followed. And generally, this clarifies in terms of when intrinsic value method needs to be used and when fair value has to be used. Now, let's take this ahead. And now, if you could please focus on different methodologies that are there for calculating this fair value per option while
Right.
recognizing the ESOP cost.
Sure. So the most popular methodology we'll be discussing here, these are the Black and Scholes Merton formula, the binomial model, and the Monte Carlo model. Now we'll discuss this one by one. Let's start with the Black and Scholes model. So if you ask me which is the most popular of even these three models, it is the Black and Scholes model. Because it is a fast to calculate, it is widely used, and most options can be valued using the Black and Scholes Merton formula. So it uses the predictable price movements to calculate the fair value of the options. And the option value is based on a set formula. Now, one important point for Black-Scholes model is that it can only be used to calculate the option value where the vesting conditions are non-market based. For example, a tenure based vesting condition or a performance target linked vesting conditions. For example, the company has a performance milestone to reach from revenue X to revenue Y. That is the performance based vesting condition. In that case, the Black and Scholes model is preferred and to be used. The second is the binomial model. Now, similar to Black and Scholes model, it is also used to value non market based vesting conditions. And the value derived under both these models is approximately the same. And even the inputs used to calculate these models are same. So how binomial model works is that it uses a tree-like structure. So a tree-like structure is used to calculate the possible price movements. So the price from here can either go up or it can either go down. And the probability is used to determine how much the upward price movement will be and how much the downward price movement will be. So these are the Black and Scholes and the binomial model. Now, contrary to these two models, Monte Carlo model is used for valuing the market-based options. So, for example, a company's vesting condition is that its share price must double during the vesting period. Okay, so that is one of the market-based conditions. So Monte Carlo uses thousands and millions of simulations to arrive at the predictable possible stock price movement. So daily calculations are done, and then the prediction is done for the what will be the stock price, and that's why it is specifically used for market-based conditions. So just to summarize, BSM, which is the most popular model, along with the binomial, they are used for non-market based vesting conditions. Monte Carlo, when it is used, it is generally used for market-based conditions because it is quite complex in nature. Yeah, they are used. So this is about the three models which you had asked.
Okay, this clarifies in terms of which model needs to be used depending on the type of vesting condition. So yeah. Now let's take this ahead, and if you could help us understand what are the different parameters that are generally used for computing the cost per option under the different valuation methodologies that we just discussed.
Yeah, sure. So there are six parameters which are used for required under these models. The first is the fair market value or the current market price of the company on the grant date. For listed company, it is the quoted market price. For unlisted company, it is the price determined by a valuer using the valuation methods. The second is the exercise price or the strike price. The third is the volatility in the share price. So, and for unlisted companies, the volatility is not readily available. So, it is the peer volatility is considered. Okay, the volatility for peer companies or for other peer companies is considered. For the risk-free rate, the risk-free interest rate of zero coupon bonds is considered. Time under expiration or the life of the option, and the last input is the dividend yield. So dividend yield is basically the dividend per share divided by the market price or the fair market value of the company. It is the expected dividend yield ultimately. So these are the six inputs which are required under these models.
Okay. Till now we have discussed, Amya, in terms of when the cost needs to be computed, how it needs to be recognized, and what are the methodologies basis which the cost gets booked. Now, my next question would be if you could please help us understand. Yes, the cost recognition is done, but also there could be a possibility of the options getting forfeited or cancelled. So, what impact generally it has on the company's P and L? So, if you could show some insights on that.
Sure. So in case of forfeiture or cancellation of options, the accounting treatment for vested options is different from the accounting treatment for the options that are yet to vest or the unvested options. Let's understand this with example again. For vested option, let's say the options have vested, but the employee has not exercised during the exercise period. So the exercise period has expired. In that case, the accounting cost, which is transferred to the profit and loss account, that will be transferred to the general reserve. So the reversal is not done directly through the profit and loss account, but through the general reserve. Okay. However, in case of unvested options, the cost is directly reversed from the profit and loss account because ultimately the employee services have not been received. And the cost is reversed only for performance based options, wherein the performance there is a non-market based vesting condition such as linked to the company's performance. Another important point to note here is that in case the vesting conditions are linked to market, like a targeted share price or targeted valuation, then even if these conditions are not met, there is no reversal of accounting cost. Why? Because these market based conditions are already taken into account while calculating the fair value. So subsequently, if the targets are not met, if the conditions is not achieved, then in that case, no reversal happens. Now there could be another case of where there is acceleration of vesting. Now that acceleration can occur on account of maybe a death of a participant, or there is permanent disability. In that case, the cost pertaining to the unvested options is recognized immediately in the profit and loss account. For example, 50 options were granted to the employee. On the date of the event, which is it can be death, permanent incapacity, or any form of acceleration, 20 options were vested, so their cost has already been booked. For the 30 options that were unvested, they are accelerated. So the cost pertaining to them will also be accelerated and will hit the books of accounts in the year of acceleration. Okay, so this is how the forfeiture and cancellation of option works in the index regime. So simply, just to put it simply, for vested options the cost is transferred to the general reserve. For unvested options the cost is directly reversed in the profit and loss.
Okay, so yeah, this clarifies us in terms of when reversals happens whenever a cost is booked. Now, so let's take this session ahead, and if you could now help us understand how exactly the disclosures works for companies following AS Ind AS, if you could please highlight on that.
Sure, sure. I would request if the screen can be presented. Can you see the screen, Devash?
Yeah, it is visible. Yeah.
Oh, great. Yeah. So let's start with the disclosure requirements. So I would recommend the participants to go through the detailed disclosures provided in the index and the guidance note. Here I have included only the mostly the disclosures which are asked by our clients to help them understand. And also this is the minimum disclosure requirement as per index. The companies are free to disclose any material events or transactions that have occurred in respect of share-based payments, and they feel it is important for the users to know about it. So companies are free to disclose them. First is the description of the ESOP plan. So details of the plan approved are stated here: the dates of shareholder approval, how much is the pool approved, the percentage of capital which is approved, and also the disclosure is generally made plan wise and not grant wise. So for example, if there is a ESOP plan 2020 incorporated in 2020 and two grants have been made till date, so then those two grants need not be shown separately but as a part of one ESOP scheme, which is ESOP 2020. The second are the vesting requirements, the vesting period or the vesting conditions, whether it is time based, performance based, such information, along with exercise price, term of the option, or method of settlement, if it is cash, if it is equity. Along with that, the weighted average exercise price of the options, as well as the number of options which are granted, forfeited, exercised, expired, and outstanding during the year, that are also required to be disclosed. Along with these, the variables which are used for computing the fair value, which we had discussed, the six inputs, along with their figures, they are required to be disclosed in the annual report as well. Apart from this, these disclosures, other disclosures are if any grant has been made during the year equal to or exceeding 1% of the issued capital at the time of grant, or any grants have been made to the senior managerial person and above. So such other information is also an important part of disclosure.
Yeah. So, Soumya, we just discussed in terms of ESOP accounting and disclosure. So, can you help us whether an expert help is required for such kind of activity to be done?
Yeah, sure. So for fair valuation disclosure, the companies are free to adopt, to free the go through the guidance of the IND AS or the AS. and make their disclosures and do fair valuation accordingly. But it is always recommended to engage an expert like Capita. So we have 2 decades of experience in this option valuation and disclosure services, and we work for a lot of listed and unlisted clients in this space. So experts have an understanding of the different inputs that are required in the option valuation and the disclosure requirement as well. So it is always beneficial to engage the experts in that case, I would say.
Okay, okay. My next question is, what are some best practices that you would like to recommend to our audiences in terms of how the ESOP cost can be managed?
Yeah. Okay. So the first one would be to maintain a real-time database of the option movement, the granted, vested, exercise, expired, and everything. Now, this is very important, especially for a listed company, wherein quarterly reporting is done and the options may be exercised at different points of time. And the exercise period could also vary between the regular employees or the employees who have separated from the company. Hence, it becomes important for the company to monitor the exercise period in that case. Also, the company should also ensure the measurement of performance rating is done on time. Now, an Excel sheet is one way, but a real-time automation software help goes a long way in keeping track of this information. Another information which you just mentioned, Devashish, regarding the fair valuation calculation. So it can become complex for the companies, and hence they should beforehand plan if they need to engage an expert for calculating in the fair value or for any disclosure requirements. The third is the with respect to the vesting schedule. Now, the vesting schedule should obviously align with the business goals of the company. Let's say the objective is retention, then a back-ended schedule of 50% vesting schedule can be incorporated. But at the time of implementing the plan itself, the company should also consider what effect it will have on the profit and loss account. So, let's say a company has adopted an equated vesting schedule. Now, the hit on the books of accounts on the first year of vesting will be almost 50% in that case. So, the vesting schedule should be designed in such manner at the time of implementation of the plan only, if the goal of the company is minimization of the accounting cost. Another important point is just being proactive in terms of compliances with AS and Ind AS and any regulatory requirements, especially for people who are forcing ESOPs in their respective organization, attending seminars and conferences regularly to stay updated with the relevant regulations and amendments or updates that have taken place. So these are some of the best practices, Devashish, I would recommend for companies who are implementing ESOPs or who have already implemented ESOPs.
Okay, this helps to understand. So, Soumya, do you have any example for our participants to understand the entire ESOP cost cycle? If you could please show us.
Sure, sure. So I have prepared one example. Hope this would be helpful. So this is a simplified version of the how the accounting cost works, but you will be it will be helpful to understand how the amortization actually works. So let's say the grant date is 1st of April 2024. Sorry, yeah. Vesting period is 3 years. The first vesting occurs on 31st March 2025. The next vesting occurs in 31st March 26 and 31st March 27. In each case, in each year, 100 options are vested. 100 options in year 1, 100 year 2, and 100 year 3. The vesting schedule, as I mentioned, is equated. The fair market value in each year is 1,000. For the purpose of simplicity, let's assume it is 1,000 each year. Now, this fair value of option will be calculated using a Black and Scholes model or any other model. And we have calculated that it is already given as 350 for year 1, 400 for year 2, and 450 for year 3. So for each tranche of the vesting period, a fair value would be calculated because as per the graded method of vesting, it is each vesting is considered as a separate grant. So separate fair values are calculated. So the total expense for each vesting tranche would be for first vesting, 350 is the fair value multiplied by 100. So that gives a 35,000 accounting cost for first vesting. Similarly, 40,000 and 45,000 for second and third vesting. And the total accounting cost is 1,20,000. Now, this total accounting cost, it will be spread in the next 3 years of vesting. In the first vesting all of the options, 33% options have vested. So 35,000 is the accounting cost pertaining to that, those vested options. For the next period, half 1/2 of the cost will be booked for year 2 vesting period, and it will be spread between year 1 and year 2. So 40,000, 20,000, and 20,000 in year 2 and year 3. Similarly, for year 3, it will be 1/3 of the cost will be booked each year. So 15,000 each year is booked. So as you can see, the expense in the initial years is higher. In 24-25, it is 70,000, then 35 and 15,000. So that is one important point which you need to consider at the time of drafting the ESOP policy, that what will be the accounting cost. I hope this example was helpful to get some idea as to how the amortization of the expense works.
Yes, absolutely. This example really helps us to understand how the amortization works for the ESOP cost. So yeah, these were the questions that I had from my side for you, Soumya. So I have a couple of questions from the participants, so that I would like to put forward. So what happens in case the company decides to, cash settle the ESOP options? If you can help us with an illustration.
Yeah, sure. Okay. So if let's suppose example, if there are 20 vested options and these have to be cash settled by the company, so the accounting cost would be recognized basis the fair value of the options. Okay. So let's say the accounting cost for these 20 options is rupees 100. Now, this settlement happens at the fair market value of the fair market value less the base price of that. So let's say the settlement happens at rupees 150. Then rupees 50, which is the additional accounting cost, that has to be taken into the books or the profit and loss account in the year in which the cash settlement happens. So whenever there is a cash settlement over and above the fair value, the incremental cost has to be taken to the books of accounts. That is the treatment of cash settlement.
Okay. Next question is also in similar lines. The second question is, in case of a cash settle plan wherein a company, is expected to make provisions and mark to market the cost at each reporting date. So let's say what happens in case, these units get lapsed or cancelled. So what treatment does it bring? Whatever cost the company has booked up till now.
Yeah, sure. See, in case of a cash settled plan, amount, the reserve is not created. Instead, a liability is created for a CSAR plan. So whether the options are vested or unvested, in that case, the reversal is made through the liability. So the liability is debited in that case. So the liability is reduced to that case. This is contrary to what happens in a equity based compensation like ESOPs, where in case of vested options, we transfer the cost to the general reserve, and in case of unvested, we reverse this to the profit and loss account.
Okay, and reversals would you mean that reverse from the P&L account as well as a reserve? Okay, okay, noted. Fair enough. Yeah, I think we don't have any more questions from the participants.
Sure.
Just let's wait for a minute, and anyone, if you have any question, please feel free to mention in the chat box. We can accordingly take it up. I think we don't have any more questions. So maybe it's a request to all the participants. If you have any questions, I will be giving our email ID on the LinkedIn post. So maybe you can on the comment section. So if you have any question, please feel free to write on our email ID, and accordingly we will address your questions. So Soumya, before I conclude, thank you so much for sharing valuable insights on ESOP accounting and disclosures. I hope this really helps our audiences in terms of the best practices that they need to inculcate for when it comes to ESOP practices. Thank you so much, Soumya. Again, yeah.
Thank you. It was
Okay.
a pleasure being here. Thank you so much.